everybody. As Kristen mentioned, my name is Casey Tollefson, and I'm the Vice President of Finance and Administration here at MCF. This is my first time welcoming everyone, so thank you for taking time out of your day to join us for our fall investment webinar, not committee meeting, as I've been saying all day. Before I kick it over to Cambridge and Associates, I just had a couple exciting updates here happening at MCF. First, I'm excited to announce that we have recently welcomed 3 new staff members. Thad Howdesell, he is our new Grants and Scholarships Administrator. Taylor Crowell, if you want to wave, she is our new Program Officer with Local Community Foundations, as well as Connie Robinson, if you want to wave Connie, she is our new Executive Coordinator. So I just want to say welcome those 3 to the MCF team. And secondly, in being consistent to help serve our constituents and develop partnerships across the state of Montana, in addition to our existing offices in Helena, Missoula, and Big Fork, we have now expanded eastward to include offices in Billings with Heather O's as our philanthropy team member there, and Jim Bennett in Havre, our new Havre office. Jim, do you want to wave? So those are the 2 exciting updates that I wanted to share, and I want to thank you all for being our partners in philanthropy and helping us cultivate a culture of giving so Montana communities can flourish. And now as we move to the investment portion of the presentation, I just wanted to start off by saying, wow, it's been quite a market. And just to remind everybody that, as you know, that even in the good times and in the down times, we do not attempt to time the market. Our pooled investment portfolio is constructed with focus on the long term. We do watch the markets closely and are in regular contact with our Cambridge team members that you see on our screen today. And the portfolio is explicitly designed to weather equity market volatility with a long-term horizon in mind. And in short, we're in it for the long haul. So with that, I would like to turn it over to Tim, Christy, Alyssa, and who else am I missing? Did I get everybody?
I think that, yeah, that's it for the,
okay,
Cambridge team, and really well said, Casey.
Thank you.
We'll touch upon our investment philosophy in part of the presentation, but Christy, if I could ask you to pull up the slides, and we'll be sure to take some pauses throughout this and take a look at the chat and see if anyone has questions. So do encourage you to voice those questions, type those questions. We're happy to make this a dialogue as much as participants would like it. As Casey mentioned, this is we're from Cambridge Associates, and we serve as the Community Foundation's Outsourced Chief Investment Office. I'll talk a little bit about the firm in a second, but why don't we jump ahead to the first page, which, as the title says, is a portfolio highlights. We think it kind of basically, as the name says, highlights some important parts of the portfolio. A lot of numbers on the page, but I'll orient you all, and we'll also dive into some of this information later. The information on the page is as of September, so as of the 3rd quarter. At that juncture, the portfolio is valued at about $123 million. If you fast forward till today, markets have come back a bit, so we anticipate it's actually a little bit higher. But again, for the purposes of this, we're going to stick with that September data. So $123 million. The portfolio allocated to a number of different assets, public equities, which includes global equities, US equities, developed ex-US markets like Europe, and then emerging markets, which include places like Latin America, as well as parts of Southeast China and other parts of the globe, made up a little over 50% of the portfolio. So, clearly a very important part of the portfolio. Private investments, which includes things like private equity, venture capital, a little bit less, more like 14% of the portfolio. Diversifying strategies, if you're looking at the left-hand donut chart, it's that purple bar. These are kind of hard to categorize assets. Some people call them hedge funds, but they're things like arbitrage strategies, credit strategies, If smaller part of the portfolio at about 12.5% inflation sensitive, which really is TIPS, which are Treasury inflation protected securities at about 5%. And then what we call deflation hedging, which is our Treasury fixed income assets and cash made up about 14%. Those allocations are very close to our long-term targets. Casey mentioned we are definitely long-term investors. We don't act overly tactical or short-term. So the portfolio is definitely allocated close to long-term targets. And that is something we would expect to be the case most of the time. We have some performance drivers. Casey also mentioned this. It's been a challenging market for most risk assets, whether it's stocks or bonds. The last really 9 months have been challenging. You have things like inflation, interest rates going up, geopolitical tension in places like China and Russia, and all of this has really weighed on markets. So you have most asset classes trading down. However, we'll take a closer look at this in a bit as well. The year actually follows 3 years of really excellent risk asset performance that the foundation portfolio participated in. So if you take that long view, you'll see that despite the kind of blip we're experiencing, it's still, really compelling. Performance for the foundation is down about 18% for the year to date, which of course is a tough number to show on the page. And, we hate having that experience. But if you put it in the context of the portfolio benchmark, which is down more like 20% almost, there's actually some decent protection going on and some outperformance versus that benchmark. And then in the context of if you were to just invest in global stocks, those are down almost 26% for the year to date through September. So actually some really nice protection when you look at those two in context. Longer term, portfolio up 5.6% since inception. For us, inception is 2016 when we started working with the foundation. So that number is net of all fees, net of our fee, net of manager fees. And that's versus a portfolio benchmark of 5%. So some nice value add net of all fees in that since inception time period. So again, if you think about it, that 6-year-ish time period actually takes into account the current drawdown we're seeing, as well as the COVID-related drawdown, which was almost seems like a lifetime ago, but it was only a couple years ago. So despite those drawdowns, still some really nice, solid performance and outperformance versus the policy benchmark. In terms of the agenda, today's roadmap for the webinar, that's at the bottom of the page. Again, this is the kind of high level overview. We'll dive into really all of this in a bit more detail, but we're going to talk a little bit about Cambridge Associates, kind of let you know who we are, a little bit about the firm, because I think that's important. Talk a little bit more about our investment philosophy, what guides us when we manage this portfolio, a bit about markets, which I'm sure we've all been watching closely, reading a lot about. So really happy to answer some questions there if anyone wants to talk about anything specifically. And then a little bit more granular information on the portfolio. We'll look at different asset class performance over a few different time periods, as well as some longer historical performance. So hopefully that all sounds good to everyone. And again, please don't hesitate to raise your hand or jump into the chat. Again, would love to make this as much of a dialogue as we can. But if we jump ahead to the first page in about Cambridge Associates. So we have a bit of a generic name. I'll admit that we're headquartered in Boston, but we have offices globally, places like Munich, Germany, which is our newest office, Sydney, Australia, Singapore, as well as San Francisco, DC, London. So it's a global firm, which is a great part about working here because I can pick up the phone and call a colleague halfway around the world and talk about what they're seeing, what's going on there. So despite that global footprint, we're an independent organization. We really only have one line of business, and that's managing portfolios for institutional clients. We do work with a range of different client types, endowments, foundations, pensions, as well as private clients. But I would say the bread and butter of what we do is working with clients like the Montana Community Foundation. Our team works with basically only similar clients, It's how the firm was founded. We were founded to manage assets and work alongside not-for-profit institutions. It's something I feel very passionate about. Let's see, looking a little bit more at the firm, we were founded in the 70s. So we've been doing this close to 50 years. We have over 1,000 employees across the globe, and we're independent. We're not owned by any kind of large publicly traded firm or a firm that might get incentives kind of mixed. So yeah, that's us. If we jump ahead to the next page, we'll actually take a look at the team. So a bunch of pictures here. You'll see me there. I'm the director of marketable investments for the foundation. We have Alicia Shing here. She's our associate director of investments. Christy, she's one of our investment analysts, but there are a number of other people on the team. And I guess we like to think about it as the best of both worlds. So you have this boutique kind of tight-knit, cohesive team. We're always on, we're always accountable. We're always, happy to pick up the phone or answer an email. You don't get lost in some huge firm. You really have a small, tight-knit team. We only work with a handful of clients, but we have the global breadth and depth of a global institution that, as I said prior, has boots on the ground. We have over 100 colleagues in research that all they do is spend time in their markets or their asset class trying to source and find excellent investments. And we get to work with them to utilize those investments for the Montana Community Foundation portfolio. So it's something I really love about working at the firm. We have our tight-knit, cohesive boutique team, but we sit on top of this global research platform. We have a number of operational colleagues. We've got compliance colleagues. It's again, we like to think of it as the best of both worlds. And we like to also think that the folks at the Community Foundation kind of think of us as their in-house investment office. Again, always on, always accountable, but again, with that depth and breadth of a global firm. So if we continue to forge ahead, talk a little bit about our investment philosophy, because I think it's really important, and I appreciated Casey's words on the outset because I think it really, I don't think I'll say it better than she said it, because I totally agree with everything she said. Our investment philosophy it's very important to how we manage investment portfolios, and it really guides everything that we do. First, we certainly take a long view. We focus on long-term compounding and growth of our client portfolios because we think that's what really matters. We do not think about market timing. We simply don't think it's a repeatable, and it can be a recipe for disaster, really. And it means often missing market rebounds, which is really not a good thing. In fact, we have a slide in a couple pages that will take a look about why that's a really not a great strategy. And it also often means locking in losses, selling things when they're down at the actual, often the wrong time to do that. So we really prefer taking a long-term approach, long-term investment partnerships with investment managers with skill that can drive out performance, while we do, look at the portfolio real time all the time. We do take that long-term approach. And having said that, we're very risk aware, and despite not making short-term decisions, especially knee-jerk reactions, we are constantly tracking the portfolio. So it maintains appropriate levels of risk, liquidity, and of course we do make incremental changes as needed. But the goal of that is to make sure the portfolio is really appropriately allocated, again, from a risk, return, and liquidity standpoint, so we can do things like meet spending and also play offense and defense when the time comes. For the foundation, our team has built a customized portfolio. I should have said this when I was talking about the team and the firm. We don't have cookie cutter portfolios. We do everything customized for our clients. Every client is different and has different needs, and that's what we've built for the Montana Community Foundation. The portfolio is growth oriented. That's something that we believe in, that the idea is so the portfolio can grow over time, increase its purchasing power above inflation. It's really so that spending that comes from the portfolio becomes more impactful in the future. Obviously, inflation, no one really thought about that for a long time, but it's come back, and it's important to think about the long-term purchasing power, which is why we have a growth orientation. We do emphasize active management. However, we only do so where we have a high degree of confidence in an investment manager's ability to add value above all fees. We hate paying fees. We try to minimize it. We try to negotiate lower fees, and we only invest with managers that we think can actually add value above the fees, and we simply think a lot of managers aren't worth the fees paid. We also are happy to use passive strategies or indexing strategies. The portfolio has exposure to these. We think it's important for liquidity because they often are extremely liquid. We think it's helpful from a fee perspective because they're extremely low cost, to the point where they're almost no cost, especially when you have an institutional portfolio like the Community Foundation, and it helps to manage exposure. So we are absolutely willing to use some passive, though we do rely on active management. Within active management, one of our what we emphasize is private investments, things like private equity buyouts and venture capital. And we believe we have a real edge in the space, and it can also be a meaningful growth driver for the portfolio, especially because the ability for private investments to add significant value over public markets. We'll look at it a bit, but we've been able to do that for the Community Foundation. We've also been able to do that historically as a firm. We do think you're paid to lock up capital, but it's really difficult. And it also is important to take that long-term approach because it takes a long time to realize that value, but it's a big part of our process. And it's something we're happy to say has been really excellent thus far in our relationship. So speaking of private investments, I think it's also helpful to maybe jump ahead to the next page to sort of look at how we kind of build the portfolio. I'll call this a building blocks, for lack of a better term, really building blocks of how you construct a portfolio. So here we have example strategies and their role in the portfolio. So first we have in blue, we have public equities. So global stocks, US stocks, European stocks, emerging stocks. And for the foundation, they make up a meaningful portion of the portfolio. As I said, from the first page, it's a little bit over 50%. So clearly a really important part of the portfolio and something we focus on quite a bit. These assets are meant to drive growth. They're really a growth driver. It's why we have a large allocation. And we do think, despite volatility and risk associated investing with global equities, that they are worth the risk because they grow above inflation over long periods of time. It's again, while we're long-term, because you'll go through these bear markets and these bouts of volatility, but it's a good place for growth. Next in green are those private investments I was just talking about. Again, this includes things like private equity buyouts, venture capital, and these more illiquid strategies are meant to be a real growth engine. So it's almost call it enhanced growth for the portfolio, and we fully expect them over the long term to outperform public markets. And it's really has to be the case in order to compensate for the illiquidity. I don't actually, to be perfectly honest, I don't think it would be worth doing if you were kind of having a public equity-like return, because you're locking up capital for something like 10 years. And again, it's something we've been successful at, and we think it's a really important part of the portfolio, and will continue to be important into the future. Next in purple is what we call diversifying strategies. Some folks call them hedge funds. However, we think of diversifying strategies as the name implies. It's meant to be a diversification tool. This portion of the portfolio is really meant to be a differentiated source of return, as well as to dampen equity risk. With a growth-oriented portfolio with meaningful assets allocated to public equity and private investments, these other kind of maybe smaller parts of the portfolio are really important to help with diversification and dampen risk. There's lots of different strategies: credit strategies, arbitrage strategies, long short strategies. There's so many out there, and oftentimes they're really not worth the fees paid. So it's a small allocation, and there's a few really high quality managers we like, and it's meant to provide things like downside protection, which we're happy to say has been the case this year. Lastly, the two parts of the portfolio are what we've called on the page inflation sensitive and deflation hedging. Inflation sensitive, as the name implies, is really meant to protect against bouts of inflation. Within that allocation are treasury inflation protected securities, better known as TIPS. Again, this is really a diversification tool. Depending if there's an inflationary shock, it's a great source of spending as those assets hold up in those time periods. And then the deflation hedging piece, we have treasury bonds. These are U.S. high quality, highly liquid treasury bonds. And despite not doing very well this year, they're an important part of the long-term asset allocation because all we have to do is back up till the COVID pandemic, and these assets were up 20-30% depending on what you had. And so they were really important then to source spending and for rebalancing. So again, the idea is to have really meaningful diversification in the portfolio so it can win in multiple market environments. There's no one asset that drives winning and losing. It's meant to provide that level of smoothness and return. And that's why we build the portfolio the way we do. In fact, speaking of diversification, if we jump ahead to the next page, we can take a little bit of a look at why. Now, I recognize there's a lot of numbers, well, maybe not numbers, but a lot of information and colors on this chart. So I'll try to unpack it a little bit for you. We call this a quilt chart. And what it is that each column is a year, in this case, going back to 2001, and each color is an asset class. So we have lots of asset classes here: venture capital, real estate, fixed income, emerging equities. The takeaway is that the colors, I should say, are all over the place, right? You have colors jumping all over the place at the bottom, at the top, and from year to year, even they'll move around. And to us, this is just a really nice illustration of why diversification works and it matters. And that's because in one year, you'll have an asset winning, just doing the absolute best, and the next year might be the worst. And so, obviously over allocating to that asset would mean a really volatile kind of crazy return, which we don't think is a great way to allocate assets, especially for an institution that needs to spend. I'll just highlight venture capital because that's something that's in the news a lot. In 2020 and 2021, it was the top performing asset. In fact, it was the top performing asset by a long shot. You go back about a little over about 20 years, 2001, 2002, 2003, it was a bottom performing asset. We all probably remember the .com crash. So again, despite it having a really, really great long-term historical return, there will be times when that asset is out of favor. And so we don't want those shorter term market environments to really impact the health and return of the portfolio. So that is why we diversify. So the next, and actually the last page of our investment philosophy section, talks a little bit why we don't market time. So here on the top of the page are returns for the S&P 500. So the blue bar up top, that is the S&P 500, which a lot of you I'm sure have heard of, and you can invest in very easily in an ETF in your personal accounts. And it's talked a lot about in the financial press. That index, probably the widest used index in the world, returned over 11% from 1980 onwards, from 1980 to the middle of 2022. So 40 plus years returning over 11%, which is a really, really good return. However, if you were to try to have timed the market and you were to have missed the 10 best days, so 10 days out of 42 years, you would have actually only returned 9.6%. Now, if you missed the 20 best days, you would have actually only returned 8.2%. And if you missed the 30 best days in that 40 plus year time frame, you would have only returned 7%. Now, I recognize this is meant to just be an illustration, and it's not necessarily realistic of how one would allocate assets. But to us, it really shows why staying invested over the long term works. I mean, 11.6% return is quite compelling. In fact, actually, the bottom chart, it's a cumulative wealth. If you had invested $1 at the beginning of 1980, you would have over $86,000 in the middle of 2022. And think of the amount of downturns that have occurred over that time period, right? However, if you had missed the 10 best days, you'd have a bit over half, $56,000, and so on and so forth. So again, it to us illustrates why timing the markets and being short-term doesn't work, and why sticking to a long-term strategy, staying invested, does work. And it's really a time-tested strategy, and why it's a core tenet of our philosophy. So I'll quickly pause there, because certainly covered a lot of ground. We have more ground to cover, and I'm actually going to hand it over to my colleague Alyssa in a sec. But just want to take a pause to see if anyone has any real-time questions about what we covered. Again, if not, we'll have more pauses and times for questions. But maybe I'll just pause for a couple seconds to see if anyone wants to jump in or type anything in the chat. Okay, great. Well, again, feel free to jump in, and Alyssa, do you want to take it away?
Sure. Thank you, Tim. So 2022 continues to present a challenging environment for investors. More recently, in October, which is shown on the left-hand side of the page, we saw a bounce back in risk markets with a rise in equities in Q3 as Q3 earnings came out stronger than anticipated. US fixed income markets were mixed as Treasury yields continued their upward climb. Overall, for the year, there really hasn't been anywhere to hide. It's been challenging across most asset classes. On the right-hand side, we have our year-to-date. If you look at the blue markers, which are our global equities, they are down upwards of negative 21% for global markets. And fixed income, surprisingly, has also posted double-digit negative returns, as illustrated by the yellow markers. To point out, the only positive area in the market has been natural resources, and that's been as a result of oil prices continuing to rise, which has increased due to the Russia-Ukraine conflict. I would note that central bank tightening has been particularly impactful on US bond markets. Inflation remains persistently high, and we expect it to continue to remain elevated in the near term. I would note that the portfolio is constructed to withstand inflation, as the portfolio holds inflation-linked bonds, also known as TIPS, and also investments in public equity managers focused on companies with pricing power that can benefit the portfolio through more durable margins. Despite the risks to the market outlook in the near term, we remain neutral to Montana's target asset allocation. The portfolio is well diversified and built to withstand volatility. As Tim mentioned, different asset classes have their strong years and also their challenging years. The exposure to the quality stocks through public equity managers should support the portfolio if the market volatility resumes. Similarly, with their flexible mandates and broader investment toolkit, our diversifying strategies managers should be well positioned to capitalize on any market dislocations. We continue to monitor the managers to better understand their positioning and the steps that they are taking to navigate the current environment. I will pause here and also welcome Tim to jump in with any market commentary as well.
I think you covered it really well. I would just maybe add one point, and I said this a little bit from the outset. If you actually look at long-term returns, even not very long-term returns, 3-year, 5-year, 7-year, 10-year, the numbers are actually quite compelling, despite this downturn we're seeing today. And more real time, in fact, you actually saw it last week with the inflation print that happened, CPI. I believe consensus estimates were something like 8.2%, and the print ended up coming in at 7.7%. So still very elevated versus history, but below expectations. And you saw markets rally right away. In fact, they were up a few percent last week alone. I think they were up the most they've been up in 2 or 3 years in a single day. So, we don't see volatility going away anytime soon, but there is, benefits to really staying invested as I think last week pointed to, and, especially if inflation is going to continue to moderate, and central banks do slow their pace, as you mentioned, Alyssa, that would likely be supportive of risk assets. There are some other kind of things happening in the market too. We still have employment near historical lows in the country, around like 3.5, 3.6%. Earnings, so corporate earnings have actually been quite resilient. Granted, estimates have come down quite a bit, but earnings are continuing to be strong. The consumer in the U.S. continues to spend money, which is really a driver of the economy. So despite a lot of the bearish things you probably read in the press, if you open the Wall Street Journal or whatever you like to read, they often make you think the sky is falling. They do need to sell paper. So there are some things that, again, we think would be supportive of assets moving forward, but totally acknowledge there are certainly plenty of risks to the outlook, and it's why we maintain more neutral positioning, and we maintain our diversification and our long view for the portfolio.
Thanks, Tim. If there are no questions on the market, we can turn on to look at the portfolio. Thanks, Christy. So on this slide, we have at the top showing portfolio growth. Since inception with Cambridge, the portfolio started at 64 million. And looking at September 30th, the portfolio has grown 59 million. This has been due to both net portfolio inflows of roughly 32 million and also a strong 27 million from investment performance. Moving to the bottom half of the exhibit, we have our annual performance. As Tim noted, it has been a challenging year. The portfolio has been down negative 18.3%, but this has been compared favorably to the policy benchmark of 19.6%, and global equity markets, for reference, are down nearly 26%. This follows 3 very strong years of double-digit performance, and over the long term, we are up 5.9%, meaningfully outperforming the policy benchmark of 5%. Looking at the next page, we have a more detailed look on asset class performance over this long time period. Equities, hedge funds, and tips have had strong absolute performance. Some of the relative contributors to performance have been from developed ex-US equity and emerging markets. Hedge funds have continued to protect, and treasuries, which is the yellow bar, is slightly down due to more recent market volatility with interest rates rising. To note, the biggest driver of performance not shown on this page is from private investments. Since inception, private investments have been up 31% versus the public market benchmark equivalent of 5%. It's been really great to see private investments be a growth driver in this portfolio, and especially as we are continuing to build the program to the 25% target, we expect to see more value-added contribution to performance from that asset class.
If I may, Alyssa, I just want to jump in and add one point, because just wanted to be clarified. So private investments, one of the parts or aspects of investing in private investments is that, unlike public markets, which you can open your phone and kind of see how they're doing every second, every day, private investments, as the nature of any private company, they only get valued on a quarterly basis, and so there's a bit of a lag effect as companies are taking, private investment firms, private equity, venture capital are taking a look at portfolio companies. They're valuing those. They're going through audits. They're doing all the same work that any private company would do. They're not as real time in terms of the numbers as you'll see from most other assets, which are traded daily globally. So in this instance, we only have private investment information through June of this year. So it's a kind of standard for private investments to be lagged by a quarter. So I just want to make sure that's not lost. And Alyssa mentioned the excellent performance, and it's still early days. The numbers will change. Private investment should be looked at over a 10+ year time horizon, but we're very encouraged by what we're seeing, and it's why we do it, really. So sorry to jump in, Alyssa, but please please continue.
Thank you, Tim. I think if we jump ahead on the performance over the 3-year, it's a very similar story to the previous page. We have US equities leading the absolute performance, and relative to the benchmark, developed ex-US equity, emerging markets equity, and diversifying strategies have meaningfully outperformed their benchmarks. Elsewhere, there's a similar divergence between TIPS, which is the orange bar, and treasuries, which are the yellow bar. Once again, the treasuries, a lot of this moderate underperformance is due to the persistent high inflation we've seen in the recent time period. The total portfolio is up 5%, which is significantly outpacing the benchmark of 3.2%. Finally, I think if we turn to the last page, we have our year-to-date performance. It's been a challenging year with all the markets down. Not the prettiest picture that we like to see, but here we can see that hedge funds have meaningfully protected as they have held value compared to equities and fixed income. The portfolio, as Tim and I mentioned earlier, down -18%, but still ahead of the benchmark of 19.6%, and equities of roughly -26%. A lot of the relative outperformance has been due to private investments, which for the year to date through June, we see relatively flat at roughly around -0.6% versus their benchmark of -20%. I'll pause here if there are any questions, or if Tim, there's anything else you'd like to add.
No, I just will say that this is the last slide of our presentation, and so we're really happy to take it wherever is helpful and answer any questions. And thanks for covering all that information, Alyssa. But again, open it up to the floor.
And if you have any questions and you just want to unmute yourself and ask, that's great. Or again, you can put it in the chat.
So I see a question in the chat from Jim, which is when do you see things turning around? Great question. I wish I had a silver ball and I could tell you the exact date that's going to happen, but we don't, of course. And however, having said that, I think I actually usually don't like to do this, but I heard a funny one the other day. It was a market research note, and it said something to the effect of, it's hard to get hurt if you fall out of your basement window. And it's really reacting, and what that's meant to talk about is the negativity in markets and the negative press that we're seeing. I mean, again, if you read the Wall Street Journal this year, the Financial Times, whatever, the sky is falling. It's the worst thing that's ever happened. And bear markets happen every couple of years. That it's not actually that surprising. And while it's very painful, and we do think and again, I don't want to make light of this, there are certainly risks. There are huge risks to the outlook. But if things like inflation continues to come down. We just saw that happen and we saw markets react positively. If we see corporate earnings, companies continue to do well, if we see employment stay strong, and we see the Fed, which is it's actually not just the Fed, it's the ECB, the European Central Bank, it's the Bank of England, it's a lot of these central banks raising rates. If they see that happen, they're going to not only raise rates slower, but they're going to stop raising rates. And that's going to be very supportive to equities and really risk assets, because the future looking earnings are that much more attractive when you use a lower discount rate. I mean, that's really what the public markets are. They're a discount mechanism. They take in all news and they're forward looking. So there is, as my funny quip was meant to be, is that there's a lot of negativity priced in. However, the opposite is also true. If I think we see inflation, suddenly go back up, we'll see markets go back down. And so there are, it's a very reactionary market right now. It always is, but there's a lot of volatility, and it's a lot of people watching the macro, which is the inflation, what the Fed is doing. Less so now what's happening in Ukraine and Russia. Well, that's certainly important, especially for things like oil markets. I mean, that's another piece, like obviously geopolitics. If something happens on that front, that would be negative to the market outlook. But yeah, I think those kind of risks are a bit priced in, and if there are surprises to the upside or downside, that's where we'll see either benefits or further volatility. I think that's like really the thing that markets hate the most. They're surprises, or they like the most, depending on the upside, where we saw the lower than expected inflation print. But that's really where all eyes are right now. It's inflation and the Fed. Okay, so I see another question that's come in, and it says, doesn't this downturn present a great opportunity for all of us? Essentially, stocks are available at a discount. I'm investing as much as I can. Yeah, how about this? Apparently, I'm quoting a lot today. There's actually a Warren Buffett quote, and he said, "I don't care if it's stocks or socks. I like to buy things when they're on sale." It's funny. Again, I don't usually do this, so I guess you got me on a funny day. But in all seriousness, I think that's absolutely true. If you have a long-term view, you have to have that long-term view, because we could be sitting here in 6 months or a year and markets are down more. I think that is absolutely a real possibility. However, if we look 20, 30, 40 plus years, and for an institution like the Montana Community Foundation that's going to be here longer than that, longer than all of us, that's why you take that long-term view. It's also why we do things in the portfolio like rebalancing. So when, let's say, certain assets have held their value and stocks are down a little bit, we rebalance back to our target and add a bit to those assets that are down. So in effect, that's doing that. And we do that all the time. So yeah, I think it absolutely presents a buying opportunity, as most other downturns have. I mean, if you had invested money in 2009 when it was incredibly scary to do that, you would have benefited. Of course, again, I want to emphasize that the long-term view is important. If you need the money in 6 months or a year, it's probably not a good idea. But for an institution like the Montana Community Foundation, it is a good idea in our opinion. I don't know if I have any more quotes, by the way, so please don't expect more.
So we will have this recorded